Exercise 21-33. We're going to use the contribution margin ratio to predict operating income at different levels of sales. So for its top managers, Worldwide Travel formats its income statement as follows. So notice this is not the normal format for an income statement. This is an internal document, and it's called a contribution margin income statement. The formula is you take your net sales revenue, you subtract your variable costs, and that gives you your contribution margin. So contribution margin is the amount of revenue left over after variable costs are covered. In other words, it's the leftover amount that contributes to covering the fixed costs. And once the fixed costs are covered, then it can contribute to operating income. And in fact, we do have an operating income of $74.05. So Worldwide's relevant range is between $253,000 and $368,000. That means between these two levels of sales, the fixed costs remain the same. So here's our requirements. Number one, we're going to calculate the contribution margin ratio, and then your managers or the CEO has asked us to do two what-if scenarios. They're wondering, they want us to do a contribution margin income statement because they're wondering what is the operating income if our sales are as low as $253,000, and what's our operating income if our sales jump up to $368,000. So in the business world, we do a lot of what-if scenarios. So requirement 1, calculate the contribution margin ratio. Select the labels and then enter the amounts to calculate the contribution margin ratio. Enter the contribution margin ratio as a whole percentage. So if you get like 23.1, enter 23%, not 23.1%. So as a reminder, the contribution margin ratio is contribution margin divided by the sales revenue. So contribution margin divided by sales revenue. And sales revenue is actually net sales revenue. So where do we get that from? We open up this box again. So our contribution margin is $180,405. Copy and paste that. Our net sales revenue is already calculated for us, $316,500. Copy and paste. And then we just crunch the numbers. So we got 180,405 divided by 316,500 equals 0.57. Now remember, this says enter it as a percentage, and we could tell because it has a percent sign. So how do we convert a decimal to a percentage? You multiply by 100 times 100 equals 57%. Of course, you could just move the decimal 2 places to the right. Well done. So now what does this contribution ratio mean, this 57%? That means for every dollar of sales revenue, we get 57% of a dollar, which is 57 cents, of contribution margin. So we already know what our profit, what our operating income is, 7405 at this level of sales. Now we've got the what if scenario of what if our sales are 253,000. So I'm going to plug in 253,000, 253, comma 000. So we're going to use this contribution margin of 57% to calculate our contribution margin down here. So remember, at a sale level of 316,500, we get this much of contribution margin, which is 57%. So what we're going to do is take this 253,000 times 57%, and that gives us our contribution margin. So again, this 253,000, so 253,000 times 0.57, which I get from right here, equals 144,200. Now that's contribution margin, right? So I need to take this 144,210 and skip a line, put it down to the contribution margin. All right, so now we have to back into, well, how much were our variable costs? Well, we're going to take 253 minus 144,210. 253,000 minus 144,210 gives us 108,790. Put the comma in there so it's easier to remember. Now there is an alternative way. Well, what we should do is we should double check our math. Take 253, subtract this, and we should get that. So 253 000 minus 108,790 should give us 144,210, and it does. Now there is another way to calculate this. So this contribution margin ratio says that 57% of the net sales revenue is contribution margin. Well, if you take the complement of 57%, that's the variable cost. So the way you find out the complement of 57% is you take 100% and you subtract 57. So 100 minus 57 gives us 43. So this 108,790 must be 43%. So another way to calculate this is we could have taken 253 and multiplied it by the complement of 57, which is 43%. So let's try that. 253,000 times 0.43 equals 108,790. So there we go. So now you don't have to do that. It's easiest just to figure out what the contribution margin is, and then to just subtract this. Subtract this from 253 gives us 108,790. All right. Then let's go see what our fixed costs are. Because they're fixed costs, they're not going to change. So this fixed cost, I'm going to copy and paste that, 173. So, looks like we're going to have a loss. So I'm going to take the 144,210 minus 173,000 gives us negative 28,790. That's not good. And of course, always put a minus sign or a parentheses for a loss. I always do the minus sign because it takes one keystroke. Parentheses takes four keystrokes. Shift, open parentheses, and then shift, close parentheses. So negative 28,790. So you'd tell your boss that we're in trouble if our sales fall to the 253,000 level. All right, so now let's look at a better case scenario. What if sales were 368? So I'm going to put that in, 368,000. Variable costs, we need to go up and find our variable cost ratio, 57%. So 57% of 368, 368,000 times 0.57. Now remember, that gives us our contribution margin. So that should be 209,760. Now we have to round that to the nearest dollar, or round that to the nearest cent, which turns out to be 209,760. Now I think this My Accounting Lab calculator is on drugs, because when I use my desktop calculator to do the calculation, it doesn't give me this decimal. It gives me 209,760. So sometimes this My Accounting Lab calculator is a little bit off. So if you want to use a calculator that's not the My Accounting Lab calculator, that's fine too. So now we have to calculate our variable cost. So to do that, we take 368,000 minus 209,760. So clear this. 368,000 minus 209,760 equals 158,240. Now that's the variable cost. Oops. Now you should double check your math. 360, let me clear that. 368,000 minus the 158,240, 158,240 should give us 209,760, and it does. Now we need our fixed costs, which are the same. 173,000, copy and paste. Ooh, good. Now we're going to get a operating income instead of operating loss. So the way we calculate that, we take the 209,760 minus 173,000. So 209,760 minus 173,000 gives us 36,760. So you would tell your bosses, your CEO or the CFO, that if our sales fall to the 253 level, 253,000, we're in trouble. We're going to have an operating loss of negative 28,790. But if we can crank our sales up to 368,000, we're going to have an operating income of 36,760. So you can use this technique to figure out all sorts of what-if scenarios. And once your manager knows you can do this, they'll think you're a math whiz. So that's it for this problem.